the two big themes which are driving the market. One is higher rates, and the other is the problem in China. Now, the higher rates are related to the war in the Ukraine, so we can kind of bundle that. But those are the two big ones. We're concerned about China. Rates are fine. This is not even wrong podcast. It's April 11th, 2022. This is Krim Delco. Since the last update, we're down about 6%. The market's down 1.7%. For the year, we're down 16%. The market's down 7.4%. We're underperforming by 8.6%. The two big drivers in the market in the last 10 days or so are US interest rates and China. Let's talk about them. We had a pretty good end of the quarter. We ended the quarter actually almost flat and then even went into positive territory last Monday. Only a week ago, we were positive in the fund, about up 2%, and now we're down 16%. So we had a correction over 5 business days of 18%. This is how brutal life can be in the markets. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund, and volatility is the name of the game. Volatility is not just something that we have to deal with and manage. In fact, we don't even manage it. We just have to live with it, and we have to embrace it, and we have to treat it as such, as part of the business. And this is what we mean when we say it's part of the business. When we have an 18% correction now, the way we do that is by managing our leverage, and this is the key to survival in this market. Now let's talk about the specifics. In the last 5 days, we had two big macro events. One is the 10-year interest rates in the US is climbing and climbing and climbing. It's now almost 2.8%. And I want to say a few things about this. First, we were wrong. We only a few weeks ago, maybe a month or two, I don't know the exact date. I'll put it in the show notes. But we had an episode where we spoke about the risk of higher rates, and we said, no, we don't think that rates will go up. We think that rates cannot go up for two reasons. One is that we have the Fed as the largest player in the market, and they will make sure that the rates only go up gradually. And second, we have so much debt now, so much debt on the government level and community level and student loan and mortgage loan. The whole of the United States is so much indebted. We have consumed so much of our future already. We can't afford higher rates. This was the thesis. It's wrong. The Fed is actually letting rates go up, probably partly because it's one way to stop the inflationary beast which has been unleashed, but also to some extent we believe that they probably don't exactly know how to stop it. The only way the Fed can stop higher rates now is by buying more bonds, and they probably don't want to do that. So that's why we have a higher rate. The only slight silver lining is that the curve is steepening. What that means is that we have a faster rise of the longer yield. In other words, people are avoiding longer term bonds at a faster pace than they're avoiding shorter term bonds. This has an interpretation typically in the financial markets of a growth prospect. So you expect growth, you expect a little bit more inflation, but also growth, and therefore you have a steepening of the curve. It's not, of course, this is not written in stone. I think that there is this saying that the yield curve predicted the 7 of the last 4 recessions, and the same way the yield curve predicted the 10 of the last 5 growth periods. So the yield curve is just a bunch of data indicating something that we, financial market participants, interpret. That's it. That's what it is. It's not a law or something like that. So let's be clear about that. But the point here is that we have higher rates, and this is a concern, but it's not the concern that we have. Like I said in the prelude, there's two big developments. One is the rates, the other is China, and China is a much bigger concern. But before I go to China, let's just finish with the rates. Why is it not a big concern? Because interest rates are, it's a natural flow of things. We get an overheated economy, interest rates go higher, the economy slows down, then we get back to growth. The stock market reacts, the stock market does what it does. But the point here is that at Orange Capital Partners, we're invested in fundamentally new concepts and engineering practice with large impact. This is what we do. So we're interested in innovation and growth, in real growth, in what Clayton Christensen called real growth. This is real stuff. This is self-driving cars. This is decarbonization of the economy. This is the Russification of the world economy. Things like that are massive developments and they are independent of things like interest rates and stuff. So if you can survive the correction period, you will be fine and you will make the returns. In our case, we hope to make 15% unlevered returns after fees and commissions. Now, the concern we have is in China. This is a different situation. China has zero COVID policy, and unfortunately, they have a COVID wave again, and they're locking down places like China, Guangzhou, Shenzhen. They're locking it down in very, very radical ways. And number one, this is very concerning in the first place. Hopefully, it's not going to last for much longer. But what we're hearing out of China is two things. One is actually we're not hearing much, which is concerning. So there's a complete lockdown on information, and also, of course, lockdown on people. People are not allowed to leave their home. People can't go buy food for shop for food, things like that. It is quite honestly very scary. It's Big Brother clamping down on freedom, Big Brother clamping down on the free move of people, on all kinds of things that we thought that China has. We thought, look, China is a capitalist regime with communist leadership, but they're liberalizing, they're letting people do their thing. And now we see in a very brutal way that no, it's not like that. This country is run by power-hungry, scary dictator type people. And even though this is a COVID situation, you might say, well, it's just a healthcare situation. Well, it is a little bit more than that. It's showing how ruthless this country is and how they're just walking over human rights beyond what, let's say, when we discussed maybe Lee's autobiography and we spoke about all the things that came to surface there, it was always within the context of, fine, this is a dissident, this is a person that is fighting the monster. And we also said that to some extent he becomes the monster. And we were kind of relaxed because we thought, well, China in the end, it will do the right thing. But now we have a feeling, well, that's not so clear. And just to use the monster analogy, the Nietzschean, if you stare too long into the abyss will stare back into you. Or if you fight the monster, make sure you don't become the monster. Well, China is fighting this COVID monster, which in the first place isn't even a monster. It's just a natural way of things go. We get infected with stuff, and we have to deal with it. But it's becoming a monster. It's becoming a very, very scary monster, and this is very concerning for us. It's concerning for the world economy, and of course, it's concerning for Tesla, which has a large business in China. So we at Orange Capital Partners have started to discount a Tesla situation where, at least for a while, there's no China business, and this would mean a massive correction in the stock, about 40% from here. So we're not back to the 600 level that we thought just a couple of weeks ago that this is the downside, but certainly it could go to back to the 750 level, 700 level, something like that. 40% from 950 would be something in the high 600s, maybe even mid 600s. Why? Well, we have, of course, a correction in China will be massive. Let's say if Tesla announced that for the next 6 months they just don't have any business in China because China is completely destabilized. China as a production hub, China as a market, everything is basically off the table. We have compensation from Austin and Berlin, both of these factories open, which is great news. And just talk a little bit about what that means for China. Of course, it's not just about the Tesla situation. We have to rethink our whole idea of China being sort of the toolkit or the toolbox of the world or something like that, where everything is produced in China. China has the best infrastructure. China has the best logistics. Well, all of these things are thrown overboard because no, China doesn't. I mean, China doesn't have a stable situation in terms of, you're not sure if they turn into a monster and just close down cities, well then, I mean, then everything is, I don't care how good your infrastructure is, I don't care how good your people are and how deep your talent pool, this is not okay. Finally, I just want to say one more thing, and this is sort of this is political. It's not a political podcast at all, but since we have to deal with macroeconomic situations, politics can be macro. there is a risk that this turns into a massive revolution. I mean, if people don't have food, if you take away kids from people, let's say, what we've heard, again, this is not confirmed, that they, let's say, if your family is infected, they take away your children, your wife, they get into isolated areas where they treat it like in a prison camp. I mean, if these things happen, people go to the streets. People, when they're hungry and when they're separated from their kin, they don't act rational anymore. And so there's a, I would say, a heightened risk of a massive correction in China in terms of the stock market and in terms of political stability. And that, of course, is the main concern we have. That's why I said, and this is now the conclusion of this episode, the two big factors. One is high rates in the US, which we're fine with. That is a natural balance of economic growth and economic overheating reversing. That's fine, but the China situation is concerning. We hope that China can get back to a more stable footing, that the monster that is being unleashed here in terms of the government clamping down on human rights in the name of COVID, that will reverse, because it is hurting China and the reputation of China as a production hub. And of course, it is hurting us with a large investment through Tesla in China. And just to finish, of course, we hope the positive outcome of this is that China reverses its zero COVID policy, that it opens up the economy, opens up the lockdowns, that it goes the flow that we in the US and the rest of the Western world have been going, most of the Western world, not everybody, but that we deal with this in a more natural way, that we open up, that we say, look, it is asymptomatic, people aren't getting sick, it's fine, and the people who are at risk, they take care of themselves, and we have a healthcare system that can take care of the people at risk. But that overall we get back to a normal footing of the economy, of an opening up of the economy, of an opening up of the human rights and freedoms that are necessary to continue with the prosperity that the country has been on for the last 3 decades. Thank you.